Narayan of StanChart joining in to talk to us. Ananth, hi. Thank you very much for joining in. We've reached 63 on an intraday basis. How important is the 63 level according to you, and do you think that we could see a pullback intraday as well?
Hi, good morning. It is an important level, clearly a psychological level that people are watching. But I think, frankly, over a period of time, one has to put things in perspective. The reality is there has been a growing vulnerability in the positioning of the rupee. We've seen more and more people going long the rupee, short the dollar, both domestically as well as globally in the form of FI, FPI flows open in rupees. Domestically alone, we think about $40 billion worth of net long rupee positions could be built up by exporters and borrowers in foreign currency unhedged basis since the past 15 months. So there is a vulnerability that has grown in the market. And in the meantime, the dollar has strengthened globally. It's moved a lot sharply since the second half of last year, and the rupee has not kept pace. To that extent, the RER now indicates that rupee is 12% overvalued. Now, all this means is that whenever you have a domestic or a global event, we could be vulnerable to sharp moves on either side. And frankly, a 1 or 2% move is not large seen in this overall perspective. Now, the immediate triggers, of course, have been the soft sentiment because of the MAT issue amongst FI, FPI flows. And now the new news that, monsoon could be below normal doesn't help either. Okay. Globally as well, there are lots of events between the US Fed and the Brexit, etc. So overall, I think this is ripe for and vulnerable for a move on the rupee. I just hope it's a mild one rather than a runaway one.
Okay, Ananth, morning. So, two-part questions. You already touched upon this MAT issue. Do you think this has the potential to drag the rupee even further from here on? And when you said the rupee is vulnerable and you hope it's not a big move, what's at risk? Is 65 at risk? Is the previous low even 67 at risk? Or is that not something that you're looking at right now?
Anuj, when the rupee is 12% overvalue on the RER, frankly, a 2, 3, 4% move cannot be ruled out. I think it could happen over time. It could happen in a short period of time as well. So 64, 65, frankly, while it might look big and hit the headlines and create a lot of flutter, in reality, in a overall scheme of things, it's not going to be a big move. And frankly, in many ways, it could be good for the country. Already our exports are hurting. Of course, it's difficult to say how much because of FX. But in a sense, there is a need for us to catch up with the rest of the world. Now, how much of this is because of MAT and FPI? I think it's difficult to pin this down. We are all hoping that the MAT issue resolves itself quickly. There's been a lot of dialogue between the government and the various players. Some clarifications came out yesterday, which was helpful. Hopefully, this will settle down, and the long-term intent is not to create any confusion amongst investors. But then, as I said, there are plenty of other issues which could, crop up over the next few weeks, between monsoons, between inflation forecasts, and global events such as the US Fed and the Greek deadline on 12th of May, for instance. Lots of events to look forward to.
So what is the range that you might be working with at this point, Ananth, with the downside scenario factored in as well?
Look, Ekta, the one-year forward premium is still at about 4.5 rupees. So that indicates that the market is looking at 67.5 as the one-year forward rate. We think the rupee depreciation will be there, but not to this extent. 64, 65 cannot be ruled out. I think a gentle depreciation is what should be the base case. Let's not forget there are long-term positives for the country as well. Oil being where it is a huge, real positive for us. It saves a lot of money in terms of actual trade deficit. And of course, the growth prospect in the long term with GST, etc., is also looking reasonably good. But having said that, I think 65 or so in a year's time seems most likely. We could see sharp moves. As I said, the market is vulnerable for sharp moves. The other good news, of course, is that RBI's reserves have gone up to that extent, and therefore their ability to control the markets is quite large.
So, at what point would you expect a big RBI intervention, Ananth, or do you think that's not necessary at this point in time?
Anuj, that question is best addressed to RBI. But if I was to put on the RBI hat, I think given that the rupee is already overvalued, it would take a while for me to actually come in and do any large intervention. They might be there to sort of temper a bit of volatility in the short run, but I don't think they would be too upset with a bit of depreciation just to catch up on the RER.
Okay. What about the bond markets, Ananth? Because we haven't seen it move much despite the news about the monsoon that came in yesterday. Is it focusing on the new 10-year issuance?
A couple of things, Ekta. One is, of course, the credit offtake still isn't great. So there is intrinsic demand for bonds. There's a lot of redemptions coming through as well. So banks will be buyers of bonds. At the same time, frankly, the conviction that we will see, deep and large-scale rate cuts is also diminishing. The reality is the RBI has put a 1.5 or 2% real rate over the expected CPI. At best, one expects that to be about 5.5% by March next year. So maybe 25 to 50 basis points of rate cuts more at the best. And of course, it doesn't help that you now have uncertainty about the monsoon. And there's also questions about what the MSPs and the minimum procurement prices will look like for agriculture. All that throws a fair amount of cloud into the inflation outlook. To that extent, I don't think the markets will be veering quickly into one side or the other. It will probably be range bound and waiting for cues.